Welcome to DWS Market Update. Every quarter, representatives of all asset classes come together for our DWS CIO Day, which I would like to report on today. The economic situation can be summarized with one simple headline: macro policy is working. Of course, this mainly refers to monetary policy. Western central banks have raised interest rates sharply in order to slow demand and thus bring inflation rates down again. The strategy is working, and inflation rates in Europe have fallen below 3% again, although at the cost of a weak economy. This economic picture is unlikely to change much in 2024. The easing on the inflation side will, however, put central banks in a position to cut interest rates again. This process is likely to start in the middle of the year and will cause yields at the short end of the yield curve to fall. For the yields of long-dated bonds, we do not see much downside potential, which should lead to a disinversion or steepening of the yield curve. On the fixed income side, we see investment-grade corporate bonds and covered bonds as the preferred asset class. The exchange rate forecasts were mostly left unchanged, as we would not expect big directional moves for the major currency pairs from today's perspective. As regards to the most important equity markets, we have raised our forecasts. The risk of a recession currently seems lower, which supports higher valuations. In addition, the share of companies that should show structurally higher growth is increasing, not least thanks to innovations in the field of artificial intelligence. We can expect the market to become increasingly nervous ahead of the US elections this fall. The outcome of the US elections, both in terms of the presidency and the distribution of power in Congress, is likely to play a role as to where markets will trade in early 2025. That said, it still seems too early to incorporate a specific election outcome into the forecasts. That's it for today. Thanks for watching and goodbye.